What's up, everybody? So we are back. It's episode number 4. I'm excited to still be doing this. It's obviously just me again this time, so you're stuck with me for a little bit. I am definitely going to make it shorter than the last one, I promise. I got some nice things to talk about here. And with that being said, let's jump right into it. Here's a list of what I wanted to cover today. So we have medical bills are now being removed from credit reports. So the credit reporting agencies will no longer be letting lenders know about what kind of outstanding medical debts you might have. That was one thing. Buy now, pay later problems. I'll talk to you about that. That's those companies like Affirm and Shop Pay, etc., what they're doing for you. Then we have IRS substitute for returns. I have something that came up with a client recently that really sparked the thought in my head that I should let people know about what this is and how to manage that type of thing. And then tax season is here pretty much. So what kind of things should you be looking out for? What should you be doing during tax season? So let's jump right into it. Medical bills being removed from credit reports. So there was a law that was passed. Now in 2023, there was already a law like this that removed any medical bills under $500 from being reported on your credit reports when the credit reporting agencies were gathering information to provide to lenders. Now that's being expanded to no medical debts at all being reported. Now, when that $500 limit was established, already 70% of total medical collection debt was not being reported. Now it's going to be obviously 100%, but it was already a big chunk before that. Now, what that means for you is that this may make you look better qualified for certain loans from lenders. And, that's a great thing for most people. Maybe, late last year, you weren't quite qualifying because you had that huge outstanding hospital bill or the co-insurance that you had to cover for some doctor's visits. Co-insurance being the portion that your medical insurance company will not cover it for you, and is the remainder that you have to pay out of pocket, and most doctors' offices will come after you for that, or hospitals, same thing. And so now you may be better qualified for a loan. So great, you weren't qualifying before, you might be better qualified now. You can get what you want. On the flip side of that thing, though, which you should keep in mind, and this is just my opinion, is that maybe you shouldn't be qualified for the loan that you're trying to get. Us Americans, we love to live at the limits of our means or beyond our means. And this is one of those things that might kind of push you more deeper into that. So just be careful. Make sure that you have all your ducks in a row, that you're on top of your finances in your home, what you can, what you can't afford, not just today, but projected for, a year from now, 2 years from now, 5 years from now, depending on the type of loan that you're trying to get. What if you're able to secure this loan today, but then you're thrown into collections for these medical outstanding bills that you have, or some other outstanding bills? You got to start paying those things. You can no longer afford this loan. Maybe you're in jeopardy of bankruptcy. The list goes on and on of the bad things, of course, that can happen to us, losing a job. And you don't want for whatever this loan allowed you to purchase or do to go away too quickly. So to where you did not even get the actual value out of it. So important to keep that in mind. You also don't want it to be the thing that propels you into that bankruptcy conversation. So for the next 5, 7, 10 years, you don't even have a normal credit history. You can't really do much like you've been used to doing. So just keep that in mind. Now, also, the other thing to keep in mind is that sometimes the reason you're getting a loan is to pay off these medical expenses, and you will still be able to provide that information to the lenders. They'll be able to obtain that information if they need to, as well as those people who receive medical benefits as maybe some sort of supplementary or total income, which they would use to prove that they could pay a loan. So you will still be able to use that. I mean, so pretty quick one on this, just something I wanted to share with you guys in case you didn't know about it yet. I think that for those whom this is important to, they probably know already, but just, my way of thinking about these things, if you will. Now, moving on to buy now, pay later. This is like a big pain point for me that I like to focus on. So with this, the CFPB, the Consumer Financial Protection Bureau, released a report last week, but this was based on 2022 research. And I emphasize that it's based on 2022 research to show that 2023 and 2024, as you likely know, we experienced a lot of inflation. Things became way less affordable for many or most of us. And so I believe that more people were likely taking advantage of buy now, pay later lending than than what it was in 2022. So likely any issues that do exist are probably much more exacerbated now than they were in 2022 research. So take this all with a grain of salt when I say it. And here, if you don't mind, I just wanted to read a couple of stats out on it. So here's what this says. More than one-fifth of consumers use buy now, pay later. Buy now, pay later is you're shopping online, you're trying to get a rug, a TV, whatever it might be, a speaker, a computer, and you have services like Affirm or Shop Pay, or now the Apple MasterCard has this service as well. Chase Sapphire, I noticed, offers this when you're shopping on Amazon. They'll say, hey, your purchase is $500. Maybe you can't or don't want to pay that all right now. Let's break this up over 3, 4, 5, 12 monthly payments. And there are going to be all different types of limitations there for you in terms of if you're a well-qualified buyer, they might say, hey, for the first 6 months, if you pay us off, it'll be 0% interest. It won't cost you a penny more. Or if you're a not so well-qualified buyer, they'll be like, okay, this is your interest rate now. And within the time frame they give you, those first, let's just call it 6 months, for example, everything's all dandy. The interest rate they offer you is low, relatively speaking, relative to credit cards, for example, or you get that 0% interest rate. But what happens when you were not able to pay off within that term? Interest rates go through the freaking roof. They skyrocket. And then these things really become unaffordable for you. And just like with securing that loan that might kind of put you in a jam later on, this is going to be the same type of thing. You have to be very careful. If you're utilizing these types of services, you got to be sure that you can pay that. And my advice would be know that you could pay that today. Who knows what's going to happen tomorrow or 6 months from now? I don't know if you're waiting on a bonus from work or an inheritance from a family member or whatever the case may be. Until that money's in your bank account, it ain't yours. You got to keep that in mind. Disasters happen, as you know. So all these things can happen. Now, it says approximately 63% of borrowers originated multiple simultaneous loans at some point during the year in 2022, and 33% of borrowers took it from multiple different lenders. These lenders are happy to give it to you. They do very light credit checks on you, and they're happy to give you this money because they're banking on this insane interest that you're going to pay them back with. Among the applicants with subprime or deep subprime credit scores, so lower credit scores, not so well qualified buyers, lenders approved 78% of loans in 2022. So basically, people who have no business receiving a loan like this are getting them. Now, this is one I really want to emphasize as well because it's for the younger population. Amongst borrowers ages 18 to 24, buy now, pay later purchases made up 28% of total unsecured consumer debt compared to an average of 17% among borrowers of all age groups. So the younger people are taking way more advantage of this. We all know that the majority, and we were all younger, we know that likely the shit that we're buying, we cannot afford or we should not afford. But this makes it so goddamn easy to just set it and forget it, right? Get it now, deal with the consequences later. So this is extremely, extremely predatory, if you ask me. We all know when we're in our late teens, our early 20s, we're young and dumb. We don't think things through. We don't know many of life's obstacles that can still get thrown at us because we just simply haven't experienced them. So we think about things in a different way. And you better believe when I'm 2022, I'm not listening to my parents tell me I can't buy the new iPhone or the new MacBook or a JBL speaker or whatever it might be. What's up, everybody? I just wanted to interrupt for a quick second to say, please, if you're enjoying this, like this video, bookmark it, subscribe to the channel. It really helps me a lot. Share this with your friends. I appreciate you all as always. And now back to the video. This is the last one. The borrowers who got the buy now, pay later stuff were also much more likely to leave balances on their other credit card accounts or credit accounts. So they're getting interest there, interest here. That $300 speaker that you bought is now going to end up costing you like $800 by the time you're done paying it off, if you even end up paying it off. So again, I really think that this is a 2022 study. So I really think that today it's a million times worse. I strongly urge everyone to stay away if you can, unless you're that person who is super on top of your finances. You do have all your ducks in a row. Everything is copacetic. And for me, I will be honest, I have taken advantage of this before in a different way. I knew that I was making a purchase of several $1,000s. They were offering me 0%. I have the money set aside in a bank account to pay it, but I know these guys are giving me 0% over 6 months. I can keep my couple of $1,000s in a high yield savings account until that term is up, earn a little bit of extra interest, and then pay it off. And I put it in a separate account just for that, knowing that this money is no longer mine. I've already technically spent it. So from, household financial perspective, and this is just my opinion, that is a way you could bring a little bit of extra stream of income, especially if you're buying something you really need to buy. So keep that in mind as well. Now, substitute for returns by the IRS, just to move on to the next thing here. If you have a year in which you did not file a tax return, maybe you were in school and you were very busy, or you had some sort of tragedy in your life, or you're going through divorce, or a family member died and you had to take care of their fine, you just forgot to file your return, or again, young, dumb, negligent, it might be that too. If you go long enough without filing a tax return and you were supposed to owe tax money in that year, the IRS will do something called a substitute for return. They have the majority of your wage and income information, because when your employer sends you a W-2, or your somebody that you did independent contract work for sends you a 1099 form, they also send that information to the IRS. So the IRS has what they need in order to create a tax return, and they will then request money for you. And keep this in mind too, they'll wait years. They'll wait years to get this done, so that throughout all those years, you've had all these interest and non-filing and late filing and late payment penalties, and interest just rack up and rack up and rack up. And this could be insanely burdening. Moreover, there are people who will get these notices that don't want to deal with them, or don't know that they can deal with them, and they'll just pay. So an example of this is somebody who is an independent contractor. They had a couple of different contractor gigs. They received several different 1099 forms. Now, if you're an independent contractor, you know that any self-employment related expenses that are ordinary and necessary to perform the work that you do can be used against the income that you earn to reduce that income and pay a smaller amount in taxes, completely legally. Now, those expenses are not taken into account when the IRS is doing the substitute for return. So it's your job to prepare a real tax return, even if you find out about this years later on, to make sure that the tax burden you have is not going to be the maximum of what it could have been. It should just be the maximum of what it should be. What I do with my clients, a lot of them, especially those that either have ended up in these situations before, or we know might end up in a situation like this, or just those who want peace of mind. The IRS provides transcripts to you. They provide account transcripts that show you what you've filed in the past, what your outstanding balances currently are, the portion of those balances that are interest and penalties. They also provide you your wage and income transcripts, those transcripts that they use to create these substitute for returns, or to know if you missed a tax form during when you were filing your tax return. And those are available to you. It's important, I think, that every year you review those transcripts. Now, for example, for 2024, the wage and income transcripts will come out somewhere around June or July of 2025. Once the tax season is done, once the IRS has finished processing everything, then they'll release this. You can go in, you can see, hey, I had a stock account. I completely forgot about this stock account. I didn't report it on the tax return. Let me call my accountant. Let me get them to fix this up. Very important to get those transcripts. You can go to irs.gov/account, log in. It's very simple to find them. Or you speak to your tax preparer. I have clients who get up with me on a monthly retainer. It's very, very nominal, and I'm just monitoring their transcripts every year. I see if there's red flags that pop up. I see if there's prior penalties that maybe I could fight off and get refunded for them. And we can always check in mid-year to see if anything was missed. Sometimes it's negligence. Sometimes it's just you just You didn't know. You forgot. Our lives are busy. It's just how it is. So, very important to manage and maintain that. And the last thing that I wanted to talk about is tax season is coming up. It's basically here. Filing season for individuals opens up on January 27th. That means we can already electronically file tax returns. Make sure ahead of time. Don't wait until February, March, or April. Now, set up appointments with your tax preparers, with your accountants, with your EAs, your CPAs, whoever you're using, with TurboTax, whatever it is. Find out based on last year, what forms should I be preparing for you? What is going to be the easiest way for me to get my information to you, the accountant, so that you can do the best job that you can for me? Is there any last minute tax planning I can still do, contributing to an IRA account or something like that to lower my tax burden? Is it worth doing that? Should I save the money for next year? Are there any credits I might qualify for? So these are the things you should be doing now to get ready for this tax season, so you're not scrambling come March or April. And keep this in mind too. It's boomer retirement season. It has been for a while. A lot of the older population are retiring now, especially with these insane, constant, nonstop changes in tax law. They just don't want to deal with it anymore. And a lot of them will retire early. That means that for the younger population, we have to deal with a much larger volume of clientele. And so we're starting to get spread thin as well. So the sooner that you come to someone like me, the better chance you have of getting the most optimal, reasonably speaking, experience from someone like me, not end up on extension, not end up owing penalties, not missing something, and especially not missing something from a tax planning perspective for the future. So, take this all under advisement. It's very important you do these things. Be proactive. Nobody's going to do things for you. You have to reach out. You have to take care of your own destiny. With that all being said, like I said, I wanted to keep it short and sweet for you guys today. That's all I have. Let me know in the comments what you think. Like, share, subscribe. I appreciate your support. I want to do more of this for you. I have a great one lined up for you next week. I think you're going to love this individual that I'm bringing on. I won't reveal who it is just yet, but in a few days you'll know. By the time this episode comes out, we should have a new president in office. That means that we may be seeing a lot of changes, especially in the tax world. Some of them might not come out right away, but many of them might, and they may impact what and how you do 2025 from a tax and financial perspective. So keep on the lookout for that, and I'll try to keep you guys posted. Let me know if you have any questions as always, and I'll see you guys soon. You can't get enough. You can't get enough.